Shalom. I'm Rabbi Isaac Rothman, and today I'm going to teach you the investing rule that built my fortune. The same rule that every wealthy family I've ever worked with understands. The same rule that explains why some people retire rich and others retire broke, even when they earned the same salary and invested the same amount. But first, let me address the title of this video. It says, Build Wealth Fast. And I need to be honest with you. Fast is a lie. Fast is what salesmen tell you. Fast is what gamblers believe in. Fast is the reason most people stay poor. What I'm actually going to teach you is how to build wealth, certainly, inevitably, mathematically. And yes, there is a point where it starts to feel fast, where your money grows more in 3 years than it did in the previous 12 combined. But you don't get to that point by being fast. You get there by being patient. You get there by understanding the rule. I call it the 8-4-3 principle. And once you understand it, you will never look at investing the same way again. You will stop checking your portfolio every week. You will stop panicking when the market drops. You will stop wondering if you're doing something wrong when your account barely moves, because you'll understand the rhythm, the pattern, the mathematics of patience. By the end of this video, you'll know exactly why the first 8 years feel like torture, why years 9 through 12 feel like relief, and why years 13 through 15 feel like magic. This isn't motivation, this is arithmetic, and if you can survive the arithmetic, you will be wealthy. Here's what nobody in the financial industry explains properly. Most people think wealth building is linear. You put in $1, you get back $1 plus some interest. You repeat until you retire. A straight line going up. Simple, predictable, easy to understand. But that's completely wrong. Wealth doesn't grow in a straight line. It grows in a curve, and not just any curve, an exponential curve. A curve that looks almost flat for years, then suddenly goes vertical. This is the most important thing you'll ever learn about money, and almost nobody understands it. Let me explain why this matters. When you look at a straight line, every year of progress is worth the same as every other year. Year 1 and year 15 contribute equally. If you quit at year 7, you've captured roughly half the value. Makes sense, right? But when you look at an exponential curve, the years are not equal, not even close. The early years contribute almost nothing. The middle years contribute something. And the final years contribute almost everything. If you quit at year 7 of an exponential curve, you haven't captured half the value. You've captured almost nothing. You did all the hard work and walked away right before the payoff. This is why most people fail at building wealth. They're mentally prepared for a straight line. They expect steady, visible progress every year. And when they don't see it, they quit. They assume something is wrong. They assume they picked the wrong investments. They assume wealth building doesn't work for people like them. Nothing is wrong. The curve is working exactly as it should. They just don't understand the curve. My grandfather taught me this when I was young. He had rebuilt his wealth from nothing twice in his life, once after fleeing Vienna, once after a business partner betrayed him. Both times he followed the same pattern. He used to draw a curve on a napkin, a line that stayed almost flat for a long time, then suddenly shot upward. He'd tap the flat part and say, "Isaac, this is where everyone quits. They look at this and see failure. But it's not failure. It's accumulation. It's potential energy. It's a spring being compressed." Then he'd tap the steep part. "This is where wealth happens. This is where decades of patience pay off in years. But you don't get here by being smart. You get here by not being stupid, by not quitting during the flat part." He'd look at me and say, "The flat part is a test. Pass the test, and you earn the steep part. Fail the test, and you start over." Most people fail the test. That's why most people aren't wealthy. I didn't fully understand what he meant until I was managing money on Wall Street, until I watched hundreds of investors make the same mistake, until I saw the pattern with my own eyes. Now let me show you exactly how this works. The 8-4-3 principle. The principle breaks down a 15-year investing cycle into 3 distinct phases. Each phase has different mathematics and different psychology. Understanding both is essential. Phase 1. The boring years. Years 1 through 8. This is the longest phase and the hardest phase. This is where 90% of investors quit. Not because they're stupid, not because they're lazy, because the mathematics are genuinely discouraging. Here's what's happening. You're contributing money every month. Let's say $500. That's $6,000 a year. The market is doing its thing. Some years up, some years down. On average, let's assume 10% annually, which is historically reasonable for diversified equities. But because your total balance is small, the actual dollar amount of your returns is tiny compared to what you're contributing from your paycheck. You're doing almost all the work. The market is barely helping. In year 1, you contribute $6,000. The market might add a few hundred. You end the year with maybe $6,500. In year 5, you've contributed $30,000 total. Your balance might be around $40,000. You made $10,000 in gains over 5 years. That's $2,000 a year, less than your monthly contribution. You look at this and think, I've been sacrificing for 5 years. I've been packing my lunch, driving the old car, saying no to vacations, and my money has barely grown beyond what I put in. Is this even worth it? This is where the psychology gets dangerous. Because the growth is slow, your brain starts inventing reasons to stop. You start calculating what that money could buy: a renovation, a new car, a trip you've always wanted to take. You start telling yourself that investing is for rich people, that you picked the wrong funds, that there must be a better way. But nothing is wrong. This is exactly how it's supposed to work. The Talmud teaches, according to the pain is the reward. Most people hear that and think it's about suffering. It's not. It's about sequence. The pain comes first. The reward comes after. And the size of the reward is proportional to the pain you're willing to endure. Phase 1 is the pain. 8 years of grinding. 8 years of feeling like nothing is happening. 8 years of watching other people buy things while you save. If you quit in year 7 because you're bored or disappointed, you've paid the price of discipline but walked out before the meal was served. Let me give you the numbers. After 8 years of contributing $500 a month at 10% average returns, you've put in $48,000 of your own money. Your balance is somewhere around $70,000 to $75,000. Not bad, you made some money. But you're not retiring on $75,000. It took you nearly a decade to get there. And if you're thinking linearly, you're calculating. At this rate, it'll take me 40 years to reach any meaningful wealth. What's the point? That calculation is wrong because the curve is about to change. Phase 2, the acceleration years. Years 9 through 12. Suddenly, things start to feel different. You're still contributing your $500 a month, but now the market isn't just helping. The market is matching you. In good years, your portfolio might grow by more than your annual contribution without you doing anything. Here's the mathematics that will blow your mind. In just these 4 years, your money tends to grow as much as it did in the entire previous 8 years combined. Think about what that means. It took you 96 months of grinding to build the first block of wealth. Now you build that same block in 48 months. You've literally doubled your speed. By year 12, your balance is somewhere around $130,000 to $140,000. You added almost as much value in 4 years as you did in the first 8. This is usually when people start getting excited about investing. They stop dreading the monthly transfer and start looking forward to it. They check their balance and feel good instead of discouraged. What's happening? Compound interest is finally becoming visible. The returns on your previous returns are generating their own returns. Your original contributions from year 1 are now over a decade old, and they've been multiplying quietly in the background. My grandfather called this the awakening. The moment when you realize that all those gurus saying time in the market beats timing the market weren't just spouting slogans. You lived through the volatility of Phase 1. You survived corrections. You didn't panic. And now you're seeing the reward. Psychologically, this phase is relief, validation, proof that you weren't a fool for sacrificing. But here's what most people don't realize. As good as Phase 2 feels, it's just the warm-up for the finale. Phase 3, the exponential years. Years 13 through 15, just 3 years, 36 months. But in this tiny window, the mathematics goes vertical. This is the part of the chart that looks like a hockey stick, the part that seems impossible if you're thinking linearly, the part that makes wealthy people seem like they have some secret advantage. They don't have a secret. They just survived long enough to reach Phase 3. In these final 3 years, your portfolio generates another block of growth equal to what you achieved in the previous 4 years, which, remember, was equal to what you achieved in the first 8 years. So, in just 36 months, you're building wealth at nearly triple your starting pace. Same contribution, same market, completely different results. By year 15, your balance pushes past 200,000. In those last 3 years, you went from 130 to over 200. The gap between years gets wider and wider, flat, then steep, then vertical. That's the pattern. At this point, your monthly contribution barely matters mathematically. Keep doing it for discipline. But the heavy lifting is now completely automated. The interest is earning interest on the interest. You might have days where the market moves up 1 or 2%. That daily swing is more money than you earn in a month at your job. It's surreal. It feels like you suddenly got rich, but you didn't suddenly get rich. You waited 15 years for the compounding curve to go vertical. The suddenness is an illusion created by exponential mathematics. This is what my grandfather meant when he said the flat part is a test. The steep part is the reward. Most people fail the test. They quit in year 4 or year 7 or year 10. They never see the steep part. And here's the tragedy. If you quit at year 10 because you want to buy a boat or pay off the house or finally take that vacation, you aren't just spending your principal. You're killing the exponential phase. You're chopping down the tree right before it bears fruit. The 8-4-3 principle shows us that the majority of the reward is backloaded. It's hidden at the very end of the timeline. It's like running a marathon where they give you the medal at mile 26. If you stop at mile 20, you get nothing but sore legs. Let me tell you about 3 people who learned this lesson, 2 the hard way. First, Jonathan. Jonathan came to me when he was 32. He was a software engineer, earning good money but spending most of it. He had almost nothing saved. I explained the 8-4-3 principle to him, drew the curve on a whiteboard, showed him exactly what would happen if he invested $500 a month for 15 years. He was skeptical, said, "Rabbi, 15 years is a long time. I'll be 47. Who knows what will happen by then?" I said, "Jonathan, you'll be 47 regardless. The question is whether 47-year-old Jonathan will have $200,000 working for him, or whether he'll be starting from zero like 32-year-old Jonathan. He started investing. The first 3 years were hard. He watched his friends buy houses and cars while he lived in a modest apartment. He felt like he was falling behind. In year 4, the market dropped 20%. He called me panicking, wanted to sell everything, wanted to cut his losses. I told him something my grandfather used to say. When you're in the accumulation phase, a crash is a gift. You're buying units at a discount. You're loading the spring. When the market recovers, and it always has historically, you'll have more units compounding for you in the later phases. He didn't sell. He kept buying. By year 8, he had about 75,000. He called me and said, "Rabbi, this is fine, but it's not life-changing. I've been doing this for 8 years. I said, "Jonathan, you've passed the test. Now watch what happens." By year 12, he had 140,000. His eyes went wide. He said, "It grew almost as much in 4 years as it did in 8. How is that possible?" I said, "That's the mathematics of patience, and you haven't seen anything yet. He's now in year 14. His balance is approaching 190,000. He told me recently, 'Rabbi, I understand now. The first 8 years felt like I was pushing a boulder uphill. Now the boulder is rolling on its own, and I'm just watching. He'll hit 200,000 before year 15 ends. And he'll keep going, because now he understands the curve.'" Second, Rebecca. Rebecca was a nurse. Came to me at 28, started investing 300 a month. Did everything right for 6 years. Then she met someone, got engaged. They wanted a nice wedding. Nothing crazy, but nicer than they could afford. She came to me and said, "Rabbi, I want to use my investment account for the wedding. I'll start over afterward. It's only 6 years of savings." I explained the 843 principle, showed her that she was just 2 years away from completing phase 1, that if she could wait, just wait, she'd enter the acceleration phase and her money would start working as hard as she did. She said she understood, but she wanted the wedding more. She withdrew the money, had a beautiful wedding, started over at 34. I saw her again at 42, 8 years into her second attempt. She had about $70,000. She did the math and realized something devastating. If she hadn't withdrawn at 28, she would have been in year 14. She would have had close to 180,000. Instead, she had 70,000 and 8 more years until she reached where she could have been. She didn't just lose the 40,000 she withdrew. She lost the exponential growth that 40,000 would have generated. She lost a decade of her compounding curve. "Rabbi," she said, "the wedding was beautiful, but I can barely remember it now, and I think about what that money could have been almost every day." Third, Michael. Michael's story is different. Michael was already wealthy when he came to me. A successful businessman who had built and sold a company. He had several $1,000,000. His question wasn't about building wealth. It was about preserving it. He wanted to know how to make sure his children didn't squander what he'd built. I explained the 843 principle to him in a different context. I said, "Michael, your children need to experience phase 1 themselves. They need to feel the grind, the boredom, the temptation to quit. If you give them the steep part without the flat part, they won't respect it. They won't protect it. They'll spend it." He set up a structure where his children would receive small amounts in their 20s to invest themselves. They would experience phase 1. They would pass the test. And only then, in their 30s, would they receive larger inheritances? His son complained, said it wasn't fair, said other rich kids got everything handed to them. Michael said, "Those other rich kids will be broke by 40. You'll be wealthy for life, because you'll understand how wealth is actually built." The son is now in year 7 of his own investing journey. He calls Michael regularly to complain about how slow it is. Michael just laughs and says, "1 more year. Pass the test. Now, I know what you're thinking. You're thinking, 'Rabbi, I don't have 15 years. I'm already 40. Or 50. The math doesn't work for me.' Here's my answer. The math works at any age. The timeline just changes what you can achieve. If you're 50 and you start now, you won't hit the exponential phase until 65. That's still 15 years of retirement where your money works harder than you ever did. That's still better than reaching 65 with nothing. And here's something else. If you're starting later, you can compress the timeline by contributing more. The 843 pattern assumes consistent, modest contributions. If you can contribute more aggressively, you reach critical mass faster. Phase 1 might be 6 years instead of 8. Phase 2 might be 3 instead of 4. The mathematics of compound growth don't change, but the inputs are in your control. Or maybe you're thinking, what if the market crashes? What if the next 15 years are different from the last 15? Here's the truth. The market will crash. Multiple times during your 15 years. I've seen 5 major crashes in my career. Every single time, people panicked. Every single time, the people who kept investing through the crash ended up wealthier than those who stopped. Why? Because crashes during phase 1 are actually gifts. You're a net buyer of stocks. When prices drop, you're buying more units with the same money. When the market recovers, you have more units compounding. The people who lose in crashes are the ones who sell at the bottom, the ones who let fear override mathematics, the ones who fail the test. The real objection, the one you might not be saying out loud, is this. Can I really be patient for 15 years? Can I really resist the temptation to spend that money? That's the honest question. And only you can answer it. But I'll tell you this, the patience required for phase 1 gets easier over time. The first 2 years are the hardest. By year 5, it's a habit. By year 8, it's your identity. You're not someone who's trying to invest. You're someone who invests. The money leaves your account before you see it. You don't even think about it. The people who can't be patient for 15 years usually can't be patient for 15 days. It's not about the timeline. It's about the character. Here's what I want you to do. First, identify where you are. Are you in the boring years, the acceleration years, or the exponential years? Knowing your phase changes your psychology. If you're in phase 1 and feeling discouraged, that's normal. You're not failing. You're passing the test. Second, calculate your numbers. How much are you contributing? When will you hit phase 2, phase 3? Make the timeline concrete. A goal without a number is just a wish. Third, automate everything. The 8-4-3 principle relies on consistency, not willpower. Willpower fails when you see something shiny or when the market drops. Automation doesn't care, it just buys. Treat that monthly investment like rent. It's a bill you pay to your future self. Fourth, and this is crucial, protect the timeline. Promise yourself you won't raid the fund for a wedding, a car, a vacation. You won't stop contributing because the news says a recession is coming. You won't interrupt the machine. In the comments, tell me, which phase are you in? The boring 8, the acceleration 4, or the exponential 3? I want to know where you are in your journey. If this changed how you think about your own portfolio, subscribe. Next week, I'm going to teach you about the silent killer that destroys the 8-4-3 principle for millions of investors, fees, and how the wrong fund can steal decades of your wealth without you even noticing. Remember, the flat part is a test, the steep part is the reward. Pass the test, earn the reward. That's not philosophy, that's arithmetic. Shalom. And may your wealth grow as your wisdom does. But before you go, I need to tell you about the 2 things that break this principle. 2 mistakes that destroy the 8-4-3 mathematics for millions of people every year. The first is interruption. Every time you withdraw money from your compounding account, you're not just taking the principal. You're taking everything that principal would have become. If you withdraw $10,000 in year 6, you're not withdrawing $10,000. You're withdrawing the $50,000 it would have been by year 15. You're withdrawing the $200,000 it would have been by year 25. My grandfather used to say, compound interest is the most powerful force in the universe, but it's also the most fragile. It only works if you don't touch it. Touch it once, and you've broken the spell. Every interruption resets your timeline. You're not just losing money, you're losing years, and years are the one thing you cannot buy back. The second silent killer is fees. To make the 8-4-3 principle work, you need clean compounding, uninterrupted, undiluted. But if you're paying 2% in management fees to some fund manager who underperforms the market anyway, you're dragging an anchor behind your boat. 2% sounds small. It's not. Over 15 years, 2% in fees can eat 30 to 40% of your total returns. It doesn't just slow you down, it flattens your curve. It turns the steep part into a gradual slope. This is why I always tell people, keep it simple. Low-cost index funds, broad diversification, no one picking stocks, no one charging you for underperformance. The 8-4-3 principle works because mathematics works. But mathematics only works if you don't let fees subtract from the equation every single year. One more thing. When you finally reach phase 3, when you see your money growing by more in a month than you used to earn in a year, you'll feel something strange. You'll feel like you cheated, like you got lucky, like it can't possibly be this simple. It's not luck. It's not cheating. It's the reward for passing the test. Everyone had access to the same mathematics, the same opportunity, the same curve. Most people quit. You didn't. That's the difference. The rich don't have secrets. They have patience. They have the ability to survive the flat part long enough to enjoy the steep part. Now you understand the pattern. The question is whether you'll follow it. Plant the tree. Water it. And for the sake of your future, don't dig it up every year to check the roots. Now go. Start your phase 1. Or continue it, or enjoy your phase 3 if you've earned it. I'll see you next week.